David Cohen, head of Asian forecasting at Action Economics. He joins us from Singapore. David, thanks very much indeed for joining us. Are they done?
We still think there's a chance for another rate hike before the end of the year, but they'll be playing it by ear, watching how the data plays out, both the inflation as well as the growth in the economy, which seems to be moderating a little bit.
Yeah, well, what about further tightening in liquidity rate, reserve ratio requirements? Could they be making more moves in that direction as well?
That's likely to continue. They need to absorb some of the continued injection of liquidity from their foreign exchange intervention. So I think they'll continue to raise the reserve requirements, as well as continue the gradual appreciation of the currency as another tool for containing inflation. After all, most people expect the inflation rate to climb higher again in June when it's reported next week. The 5.5% year-on-year in May was the highest in 3 years, after that, the likelihood is that maybe the base effect will be a little friendlier, and the inflation could slip back below 6% going forward. But like central banks everywhere, the PBOC will play it by ear.
Yeah, I mean, everybody mentions these base effects. So we peak out, what, 6% or thereabouts in July and August, and then we see a fallback here as well. But what about the trade-off with growth? How is that equation going to work out?
Well, our expectation is that they will be able to achieve a soft landing. After all, the attention to the purchasing managers' indices for June, that they slipped back toward the neutral 50 level, but they did remain expansionary, and there's still considerable momentum in Chinese domestic demand for both consumer and investment spending, and a question mark clearly remains surrounding export demand. The consensus is that the soft patch in global growth will abate as we move into the second half, and that should help Chinese exports, including to the recovering Japanese economy.
David, I want to just talk about, you've mentioned some of the headwinds that they're facing right now. We've talked about inflation. We've also talked about the slowing growth prospects there. But what about the banking sector? Are you concerned there? We had Moody's, of course, look at their credit quality, not like what they see.
There's no doubt been some renewed nervousness about the debt of the local governments, but I would think that the Chinese financial position remains solid, supported by their $3.5 trillion in international reserves, which makes for a stronger financial position that the central government could absorb some of the problems at the local government level.
I just want to talk to you about, I mean, you're sitting there in Singapore, and of course is one of the world's biggest sovereign wealth funds there, Temasek Holdings. Now, they got out of positions in many Chinese banks, a couple of Chinese banks anyway, $3.6 billion worth of positions here in terms of selling their stakes down. What do they know that other people don't?
They characterize it as rebalancing their portfolio a little bit. I think it's just an issue of prudence, not wanting to have all your eggs in one basket. They were some of the largest holders of stakes in those two Chinese banks, and perhaps they thought this would be a prudent time to diversify a little further.
David, thank you very much indeed. David Cohen there, he's from Action Economics, is talking about that rate rise coming out of Beijing, and of course Temasek Holdings' sale of their stakes in a couple of Chinese banks.